You ever look at a stock and just feel kind of overwhelmed? Like you're drowning in data and you're not sure what actually matters? Well, today, we're going to cut right through all that noise. We're using a simple but really powerful framework inspired by one of the best investors out there to analyze a pretty fascinating company. All right, so here's how we're going to break this down. First, we'll talk about our framework, the Buffett-style check. Then we'll dig into the company's quality and how profitable it is. After that, we'll check out its growth engine, ask that all-important question about the price, and finally, we'll face the big dilemma that all this data leaves us with.
So the whole philosophy here is famously simple, and it comes down to two things. First, find a truly wonderful business. Second, and this is just as crucial, don't overpay for it. That's it. That's our checklist. And the company we're putting under the microscope today is the semiconductor giant Micron Technology. It's a perfect company for this kind of stress test because, its market can be really up and down.
Okay, let's get right into our first big test. Is Micron a high quality, what you might call a genuinely wonderful business? The best place to start looking for clues is in the numbers, specifically its profitability and its financial health. A really key metric for measuring quality is something called return on equity, or ROE. You can think of it like a report card for the company's management. It basically tells us how much profit they're squeezing out for every single dollar the shareholders have invested. A consistently high ROE, that's usually the sign of a top-tier business. And wow, check this out. Micron's return on equity is an incredibly strong 33.28%. Now that's not just good. That's a huge signal that this company is an extremely efficient profit-making machine. So for our first test, that's a big, fat check mark. But hang on a second. High returns can sometimes be a bit of a mirage. Is the company just juicing these numbers by taking on a mountain of risky debt? A truly wonderful business shouldn't need to do that. So let's take a peek at Micron's balance sheet. And the answer is, well, it's pretty loud and clear. Micron's debt-to-equity ratio is just 0.14. That means for every dollar of equity, they only have about 14 cents of debt. That is super, super low. It tells us that this impressive profitability is built on a solid foundation, not a house of cards made of debt. All right, so it's profitable and it's financially sound. That's great. But a wonderful business doesn't just stand still, right? It's got to be growing. So is Micron actually expanding? And more importantly, are its profits expanding over time? Let's take a look at the growth engine. This table, man, it tells a pretty incredible story. We're looking at something called the compound annual growth rate, which smooths out the bumps and gives us an average yearly growth. Over the last 3 years, revenue grew by over 36% a year. But get this, the net income, a mind-blowing 147% per year. So this business isn't just growing. Its profitability is absolutely exploding. Okay, those earnings numbers are amazing, no doubt about it. But you know the old saying in investing, right? Cash is king. You see, accounting profits can sometimes be, let's say, flexible. But the actual cash flowing into the business, that's a lot harder to fake. So let's see how Micron is doing on what might be the most important metric of all, free cash flow. And the number here, it's almost hard to wrap your head around. In the last year, Micron's free cash flow has grown by over 1,600%. That shows an absolutely incredible and accelerating ability to turn what they do into cold, hard cash. All right, let's take a breath here. The evidence so far is pretty overwhelming, isn't it? Highly profitable, very little debt, and explosive growth. It's really checking all the boxes for a wonderful business. But that's only half of our checklist. Now we have to deal with the second part, which is just as important. Can we buy it at a fair price? And this is where our story takes a huge, dramatic turn. On one side, you have the market price, what you'd have to pay for the stock today. And on the other, you have an estimate of what it's actually worth, its fair value, based on the cash it's expected to make in the future. And that gap, well, you can see for yourself, it's pretty significant. This brings us right to a core idea in value investing, the margin of safety. It's basically the buffer between the price you pay and the value you get. It's like buying $1 worth of business for 50 cents. That buffer is what protects you if things don't go exactly as planned. And yeah, this is where the sirens start blaring. The margin of safety for Micron is negative 401%. Let that sink in for a second.
This calculation is telling us that the stock is trading at more than 4 times its estimated intrinsic value. The safety buffer isn't just zero, it's deep in negative territory.
So, what do we do with all this? Where does this leave us? We've run the numbers, we've followed the framework. Now let's put all the pieces on the table and see what kind of picture emerges from the data. I mean, the story here couldn't be more black and white, could it? On the one hand, you have all the signs of a truly phenomenal business. Incredible profitability, a balance sheet that's like a fortress, and just off-the-charts growth. But on the other hand, you have a valuation that seems totally disconnected from those facts, a price that just looks extremely, extremely high. And that right there, that is the ultimate investor's dilemma. We found the wonderful business. That part seems clear. But the market found it too, and it has priced it for way beyond perfection. This forces us, and you, to ask the one question that every great investor has to wrestle with. For a truly great business, is there a price that's just too high to pay?